Good evening, ladies and gentlemen. Welcome back to this very intriguing journey of my Friday night live streams. I've been trying to find a consistent time, 10 p.m. Fridays. I don't know, it seems to work, but we got so much I want to get into today because I need your help. I'm in this really divisive phase of being a little bit younger, trying to build my own portfolio and constantly adjusting things thanks to the volatility that life always presents itself. And I have a little bit more room to play with in my youth, looking at 30 years ahead. Obviously, want to fast track retirement, but with that longer time horizon, obviously, I'm not looking to just retire in the next 5 or 10 years. I mean, this is a continual journey that will go far beyond any capital growth I have into a frame of making enough to retire at any time, because it's like you're never going to retire, right? But then on the other spectrum, I have this conservative nature of, my parents are heading into retirement. I'm actually watching a lot of retirement YouTube channels and conversating about those kind of stocks. And I need your help kind of divisively figuring out, if you had to retire tomorrow, let's say you're done working, you just want to live your life, go out, travel, how would your portfolio look? I'm going to break down what I think this is just a general. I've been manicuring, that's the right word, a ton of different portfolio types for a retirement-like portfolio. And we're going to look at those kind of stocks. We're going to go through all of them, high dividend yields. We're going to look at option ETFs, the things I don't like, because I found an incredible one that has actually performed exceptionally well. We'll take a look at a whole spectrum of ETFs. Then we're going to talk, obviously, about my portfolio. We're going to talk about billionaire portfolio Bill Ackman, who recently came out on CNBC, recently bought Google. I talked a little bit about that today. We'll look at more robotics, as last time I kind of gave you a spectrum on what the 1980s folks thought the future was going to look like. This time we're going to take a look at exactly what's going on in the future from the beauty standpoint of things on the robotics level. It's kind of astounding. But first, we'll do a little bit of housekeeping here. I'm going to share with you a little bit of humor on Mark Zuckerberg and the VR. But first and foremost, I really want to say congrats to Ryan here, because he just closed on his first home today, 7.95%, 30-year fixed loan. Congratulations, man. I know when I bought this property and we just moved in like a month and a half ago, I was getting reamed out so hard. Oh, you're buying real estate at the worst time. We locked in a 5.89% interest rate, put a huge deposit down on it, but now we have this controllable fixed expense because obviously we wanted to live somewhere, right? We're getting into our 30s, saved up, let's get out, tired of living with the parents, fiance, looking to get married, all this stuff. But it's so ridiculous to pay like 40 grand a year in rent, and that's what we were facing, right? So we're saving like $1,000 a month. So congrats. I'm glad you guys were able to pull the plug and find something. I feel like this is the market to do it, especially if you have the capital to kind of get the pricing reasonable, because I don't think anyone's taking on a 7.95% loan without putting a pretty massive deposit. So yes, congratulations, Ryan. There's so many comments already. We're going to get into some of these, but first and foremost, I do want to talk about the metaverse, because this touches close to my heart. Meta has probably been one of the longest standing stocks in mine and my fiance's portfolio. It's been actually one of our largest holdings for quite a period of time. Now, I flaked out on this company. I should have kept with it, but I sold out when the market first dropped because I didn't trust anything around the 220 level on this little bump here. And I missed out on about 30-40% of gains if I just held through it. My fiance was fortunate enough to catch this during the pandemic lows. I think her average cost was like 150, 160 a share. She rode through the entire volatility. She has a better mental fortitude than I did, and she's seeing some pretty wicked gains on this right now. But the reason I'm bringing this up is because we're seeing this continuation, this evolution, and the competitiveness of what the virtual reality space is going to start looking like. And if you didn't see this video, I think I shared a few clips this week. I'll just show you a quick highlight, and then I'll show you what my experience in the VR world is actually like. But
this conversation with Mark Zuckerberg inside the metaverse. Mark and I are hundreds of miles apart from each other in physical space, but it feels like we're in the same room because we appear to each other as photorealistic codec avatars in 3D with spatial audio. This technology is incredible.
I don't know. The reason they do this kind of like LiDAR scanning stuff is because the bandwidth is so much greater. They mention a lot of this in here, but this is kind of what the vision of what they want the metaverse to be. And it's cool,
people
right?
can see this, but this is incredible.
However,
the realism here
this isn't where the metaverse is at the moment. The fact is, I keep telling you, like, Metaverse dropped this Quest Pro and no one gave a crap. Like, they discounted the crap out of the thing. You can buy it. Nobody's using VR for any of this stuff. It's primarily gaming. Gaming is going to control the future of entertainment. It's just where most of the money and like attention is, especially from the younger generation, right? So I am going to be picking up the next Quest because this just dropped. I haven't pre-ordered it just yet. It ships October 5th, but I'll probably pick it up early next week, and I'll try it out and let you guys know what I think of it. But in comparable to Apple's experience of their $3,000 VR headset, it's hard to compete in the price point where kids and people can aspire to utilize the thing, right? And unfortunately, Apple has no gaming representation as much as Meta does. So I think I'm really intrigued to see what the sales numbers are going to look like. But this is just my humor. So take it with a grain of salt here. But I've been playing these games now. I've been in the metaverse for like 2 years. I've completely given up on Xbox and all kind of other gaming. And I've got fixated on a few different games, but I'll give you an idea. This is just my kind of humor of messing around. So just bear with it, but you guys can tell me what you think.
Friendly?
Yeah, friendly.
Oh, awesome. What's your name, mate? What's your name?
Eat skeet. And I think I broke my leg.
Yeet skeet. How long have you been playing for, my friend? How long?
3 days.
Oh, you're brand new. So I do clips. I try and teach people lessons. Have fun. It's kind of like streaming, right? You like sing-alongs? You know.
A little.
All right. Do you know the song? Mama, I just killed a man. Put a gun up to his head. Pulled my trigger, now he's dead. Mama.
Yeah, I'm more or less a troll. My buddy hates when I play games because I just kind of have a little fun with word manipulation, I guess you could say. I'll share with you one more clip. I don't want to get too deep into this. It's just if you've never played VR, the interactive experience of moving around and like having these kind of experiences, and the way Mark is presenting it, we're nowhere near that level yet when it comes to like the average user in VR. It's still very cartoonish like, but here's just another funny little clip.
You know what, my friends? Hey, I'm offering undivided friendship here.
Where are you?
You can kill me at the end if you want. We can muck the whole lobby.
Well, I could just kill you right now.
You could, but why can't we be friends? Why can't we be friends? Come on, man. Give me a good clip here. We could have some fun together.
It's funny. I forgot that we had proximity chat. It's my first time playing this in a while. All right, yeah, sure, why not? Come on.
All right. Let's go.
Let's
So
take
this
it
is
down.
like a player versus player. So for these people that team up with me, it's like they could just turn around and kill me at any time. It makes it super entertaining. Unfortunately, I lost this guy at the end.
They can't do shit.
Yeah, there's some kids crying right now.
Oh my god, they're
Oh,
right
God.
next to each other.
No, my buddy. Hey, you killed my buddy. What are you doing, mate? You can't kill my friends. Fuck you.
So I just mess around and be really cheesy with it. But I think people need to understand that like to watch this isn't the same as to experience it. I actually, the other night we have people, and I think I mentioned this before, that manage like the recreational center here. And I was talking to this guy about VR, and he was just kind of crapping on it, saying, when it gets better, I'll get it. But I'm like, you've never actually tried it. A lot of people pick on it, saying it's cartoony, it's that. So I actually brought it down to him. And his first experience, I have a video of it. Obviously, I won't share. It's a little bit more private for him. But it was so incredible to see his initial reaction to it. And if you've never tried it, please try it. It is phenomenal beyond belief. But putting that aside, folks, let's take a look at the markets this week. And I want to get into building out this kind of retirement portfolio. And then we're going to get more into my portfolio side of it when it comes to these kind of tech companies, because I still believe that VR experience is going to become exponentially greater. I feel like it's the N64 days of like, just that next level of tech. So it's very intriguing, right, to be on the early days of this. But taking a look here, first and foremost, the markets have been pretty abysmal on both sides of the border. I mean, take a look at the Canadian markets, and the oil energy is the only thing that really kept anything up. I mean, oil just absolutely slaughtered this week. CNQ was up dramatically. I mean, 5% gain, which is really unusual in the Canadian markets to see these kind of fluctuations, because typically on a week, you see the banks trade up or down a couple percentage points. But oil's been coming back with a vengeance here. On the U.S. side of the border, it's been a bit all over the place. Apple getting hit a little harder this week. Berkshire pulling back. Tesla managed to get squeezing a bit of gains out of the week. And for how volatile companies like Tesla are, when you zoom out over a week, it's just like it's barely up or down. It's kind of incredible, really. Proctor Gamble getting hit pretty hard this week. We're getting back into this earnings period. And we'll talk about just my plans through the earnings period and just kind of getting into the end of this year, because I'm, again, still in this really fickle, complicated situation of just trying to readjust my funds. But when it comes to building this retirement portfolio, these conversations I'm having daily with my family, my parents, I'm trying to figure out, like, when it comes to higher yield, when you just want cash flow, I watch PPC in, I watch a lot of these retirement channels beyond that offer a lot of incredible insight. I've been going on a lot of trading platforms that, like Blossom here, that show you a lot of different people's portfolios. And I'm trying to look at the older generation just to see, in that conservative day of nature, like that age, like what are these people doing with their portfolios? And I've seen extreme conservative, less conservative, but at the end of the day, they're all relatively more conservative than, I would have anticipated them to be, because people at that age, like when you see people like Kevin O'Leary, or you watch, because Kevin only really talks about his growth stocks. When we look at Berkshire or Pershing Square Holding, Bill Ackman's portfolio, you'll see it's not as conservative either, right? But even with Ray Dalio, like when I watch Warren Buffett or Ray Dalio, like those portfolios are conservative, but they're much more individually stock concentrated. Whereas these days, I'm noticing people are moving more into option ETFs, high yielding ETFs that we're going to take a look at on the Canadian side that most of you are very familiar with. But I did stumble upon this. As many of you know, I don't like things like HMAX. I'm just not a big fan of things like TSLY, like a lot of the high yielding option ETFs. I know a lot of people are fans with them. There's nothing wrong with that. It's just my personal opinion. So when, people are going to retirement, I'm like, obviously, options can give you a great exposure to a whole different sector of the market, so you're not over concentrated, and you can get a higher yield off of them and still get continued great performance. And this ETF that I came across just randomly kind of blew my mind, because this is the BMO covered call DGIA hedged to CAD ETF. So it's great because it's more of a Canadian currency focused ETF. And if we just take a look, I don't like the expense ratios. They're much higher, 0.65 management expense, 0.72 for option ETFs. I think this is pretty common. And the yield's only 6.59%, which most people would laugh at. They'd be like, oh yeah, well, when you can get 10 or 15% off an option ETF, why would you buy this one, right? But as I mentioned, when I'm looking at ETFs specifically, I demand just a few things. Over a 10-year period during the greatest growth cycle the S&P and the markets ever experienced, I want at least a doubling of my money and an increasing of the dividends. And it's crazy how hard that is to find over a 10-year period, because if you're not going to do it, I might as well just put my money in the S&P and forget about it, especially if I'm not spending the money, right? But when it comes down to cash flowing, it's a demand that I don't think is that much to ask when you need to rely on it, not for the next 10 or 20 years, but today, right? And look at the performance of this. Since inception, this thing, you put $10,000 in, and today, I mean, it'd be worth around $28,000 at the peak there. It's worth around $30,000, very stable. Which is something that I like to see. But on top of that, I mean, you're talking about, look at this, look at the holdings in this ETF. You're talking about United Health Group, Goldman Sachs, Microsoft, Home Depot, Caterpillar, Amgen, McDonald's. For Canadian, this is a pretty wonderful portfolio to write options against, right? Or probably, and just collect the premiums. But the thing about this, sorry, I'm stuttering a little bit here, but look at the dividend. The dividend over 10 years has gone from 7 cents to 13 to 14 cents. The only thing I'm seeing with option ETFs is the opposite direction these days. So I'm really impressed at how they have managed this. It only has one caveat that sucks, and that is this stock has absolutely no volume. I'm finding the more intriguing companies tend to have way less volume. I mean, look at this, 1,400 shares traded in a day. That's like peanuts, right? The average volume is like 2,700 shares. So it's a little bit abysmal at best. But let me just get through the rest of these, and then we'll kind of open it up to the chat group here. But I really want you guys to let me know in the comment section below, and take your time even after the stream, and just write me out how you'd percentage allocate a portfolio of a simplified portfolio of stocks that have a higher growth income, right? They generate more passive income, and just tell me what you'd make a percentage of that. I'd love to hear about it. But getting into this a little bit farther, there's also like these two ETFs that I think are a must own for a retiree, and that's XIC. I mean, this is the iShares Cap Composite, index here ETF. This is more of this is the more dividend growth one. Let me pull this up here real quick for you guys. I'm already just squirreling out here a little bit, but take a look. Is this the dividend one, or am I looking up the wrong one? I'm looking up the wrong one here. What's the? Let me pull it up here real quick. I'm already messing this up. XEI. Sorry, I backwards those tickers up. If you've never seen XEI, it's like an equal weight Canadian high dividend yield index. It's actually green year to date just because of the dividend payouts. I think it's up 3% year to date. But just take a look at this one, because again, absolutely incredible. Really low maintenance fee on these ones, similar to VDY. This one's yielding 5.36%, which is absolutely astounding. If we just scroll down, the maintenance fee should be right here somewhere at 0.2. So exact same as VDY. You're getting over 5% yield after the fee, and you're looking at equal weighting things like Enbridge, Suncor, Toronto Dominion, Canadian Natural Resources. Again, I talked about these ETFs, I think, even in some of my videos this week. Heavily energy, financial, concentrated, and utilities, communication, etc. And I would pair this with VDY because both of them are monthly paying, and VDY pays a little bit less, but has slightly outperformed it over the long term. But I think if you paired these together, you'd get a good weighting of the best Canadian dividend stocks. You'd get a monthly paycheck of almost exactly 5% between the two. And everybody knows VDY. I kind of beat this like a broken record, so I don't think I have to. I don't think I have to deep dive into this one too much farther, but I'll show you what I'm looking at like an allocation standpoint. But there's also money market funds. So I was looking at people like Brandon Beavis's dad. I don't know if you've watched. I'm sure many of you watch Brandon Beavis. His dad has been doing a lot of like the news stuff, and I went and looked at his portfolio, and I noticed he has a huge proponent of these money market funds. And right now, this BMO money market ETF, which is where everyone's money is sitting, as I've mentioned, so much capital is just sitting in these funds. I mean, the expense ratio is super low. Starting yield's 4.29%. It's not like the high interest savings accounts. This will probably take an advantage of the interest rates for a longer period of time. Whereas high interest savings, you'll get over 5%. But obviously, as those promotions change, as the banks flip around their promotions, those are really short-term investment vehicles where I highly doubt over the long term you'll be able to equalize out whatever the conditional interest rate on the market is. Whereas this is more just specific interest rate focus. But again, it's just primarily focused on things like Bank of Nova Scotia here. So I mean, just these money market funds tend to just focus on things like Enbridge Pipeline. But again, they're much more stable to the conditional interest rate, in my opinion. But again, all these things change over time. But money market funds are super safe, low risk, a very intriguing investment. And on the US side, obviously, I'd take SCHD. I love my Schwab US Dividend Equity ETF, one of the largest holdings in my portfolio. This is just for that US exposure. You'd want to put this in a tax-free advantaged account because obviously you're getting the 15% withholding as a Canadian. But at the end of the day, I don't mind sacrificing 15% for the exposure and the growth something like this offers, so long as I'm not paying any other tax on it. Because Canadian stocks outside of tax advantaged accounts are actually tax efficient, because the government says, hey, if a Canadian company makes 50% of its earnings in Canada, we'll deduct your taxable income down to, I think, like 15% or something like that. And same with cap gains, right? If you get good capital gains as a Canadian, you only pay tax on 50% of those. So I think you want to pair these very specifically, and that's another conversation in and of itself, the tax efficiency of it all. But I love SCHD. So this is one that I would put in, and to show you how I would weight all of these out together in a retirement portfolio, including some individual stocks. This is one of like 4 or 5 variant portfolios I've put together that I've been sharing with people. There's a lot of different directions you can go in, but I figure you want about 80% of the portfolio in a very stable, 80 to 90% almost purely stable, ETFs, passively managed. You don't want to have to ever touch it again. And even this might be too highly exposed for some retirees. Maybe you'd go more money market funds and high interest savings. But to give you an idea, I basically weighted VDY and XEI by about 50%. I put basically SCHD at about 19%, maybe even weight that a little lower. You're going to take that kind of, that option ETF company. I put that at about 10% weighting just to get more US exposure and get some more, cash flow coming off US based stocks, 5% in the money market fund, and then just a slew of individual stocks like MCAM Mortgage Group or Power, Manulife. I think you need more stable growth stocks in here as well. Maybe like Hydro One is something that I think my mom's a fan of. There's a lot of different good stocks. I also like CNR, the Canadian National Railway. I think that would be a good growth proponent as well, because I think this is a little too dividend concentrated for higher yield. And there's a lot of risk in these higher yield stocks, which is why I wouldn't over concentrate them, because there's a high percentage that those dividends could get cut in the near term. Obviously, there's a lot of room to play around with things like TELUS when it comes to their business with them laying off employees, finding ways to cut costs. But the fact is the interest rates are catching up to them, and they're paying massive payments. I think they're going to be at like $1.5 billion, 1.7 or 8 billion probably by the end of the year in interest payments. I think they're doing like half a billion a quarter almost. I mean, we're talking about, I think if I ran the math on that correctly, I have to go back and look at their balance sheet, but it's ridiculous how much interest is starting to affect these companies. And we're seeing REITs get hit. Honestly, the annoying thing is the things that are getting hit are almost the things you should be focused on buying, but the risk associated with it right now makes it hard to stomach. But that's the risk reward appetite that you need to have if you're buying individual stocks. When it comes to REITs, I mean, you look at MPW, that's probably still a huge value player if they can keep their earnings where they're currently at. You look at things like the Canadian version of Medical Properties Trust, which is Northwest Health Properties. That one recently cut their dividend. The True North Commercial REIT. I mean, I'm just watching REITs get slaughtered left, right, and center, and it is a crazy, scary thing to hold because they don't have room to play around with. They can't lay off employees. All their money pretty much goes out to dividends, and they are completely, controlled by mortgage rates. So it makes it very scary. Whereas things that I've talked about before, like MPW, for example, these are the companies handing out those loans. So they're on the other side of it, right? And they don't have the same exposure the banks do because they're not in the same position to put necessarily loan loss provisions aside. Sorry, I keep messing this up here. It's called MKP. This is one that I've been following for a while, and I've seen a few stocks like this in this higher interest rate environment just absolutely crush it because they're third-party lenders. And these third-party lenders already were handing out massive loans. So they're in an environment they're already used to, which I think is actually helping stabilize some of the performance. But this 10% yield is insane next to this 6 price to earnings multiple and the growth this thing has had. Again, I'm not saying these are a buy, but they could be a more speculative, smaller percentage in a high growth portfolio that's more retirement focused. So, I mean, there's a lot of risks. You got to be really careful with the individual stocks. If I had to pick one individual stock that I would rely on right now for dividends, that would be British American Tobacco. At the end of the day, you always end up coming back to like where the most stability is, not in the stock price, because you're not going to get any growth out of a company like BTI. I've stated this before, and I talk about it like a broken record. There will be no growth out of this ETF because earnings are not the end all be all to stock performance. I know it's crazy, right? Everyone talks about earnings. You got to have earnings behind the company. If there's no earnings, the company's not going to grow. Well, then how do growth stocks grow that have negative PE ratios and no EPS? Because like Amazon spent all their money for decades. Like earnings are one of the factors to the full scope of the story. I kind of beat up everything money this week talking about that. But British American Tobacco, doesn't matter how cheap this thing is. The fact is there's no major investors. There will never be a major investor because it doesn't meet those ESG, those environmentally friendly rules that every fund is following these days. And that's why when we look at the institutional ownership, it's only 7.9%, which is damn near laughable. But when you look at the payout ratio for a company paying almost 10% yield here, you're talking about a 44% payout ratio. This is one of those companies with like, you just look at the earnings on this and it's almost damn near jaw dropping, right? Like, look at this stable earnings. The tobacco sector, there's no better sector for income, in my opinion, especially if you're a lot older, because you don't really need to worry about the risk of smokers switching over to say vapes, which again, BTI is doing a great job of that. But you don't got to worry about the speculative future of innovation in the tobacco sector, because you're in the same lifeboat of many other smokers, right? Because I think the general age of smokers has gone up pretty dramatically for combustible tobacco, right? So I don't know. If I had to pick one end all be all for cash flow tomorrow, and I don't care about capital growth, and I can rely on it at least probably for the next 20 or 30 years into my retirement for high yield, BTI is going to take the freaking cake. But I'll listen to a few of your guys' comments and questions, and then we're going to take a look at Bill Ackman's portfolio, because he's an incredible dude to listen to. But let's get into this real quick, because down on O big right now and adding, so O Realty Income's one that they are trying to innovate in their investment thesis. That real estate investment trust is a really stable underlying investment, when it comes to their diverse portfolio of, just the real estate they invest in, like convenience stores. I think they do like some of the triple net leases to things like the big grocery stores or things like Home Depot, but they are starting to diversify and do something they've never done in their business. And that is invest in things like casinos, like Wynn Resorts. And people are skeptical on if that's a good or a bad idea, because typically in recessionary periods, you think people would gamble more, and right now gambling is exploding. But in real recessions like 2008, those stocks tend to get hammered pretty hard. They don't have the same kind of I would like to say they're recession proof, but they're definitely a different form of diversification for them. But I think they're investing also in those growing, what are they, like the indoor grows for plants and food and stuff. I think their business, you have to really deep dive into it, because it's definitely probably one of the best REITs in the US, and it's probably one of the most talked about for sure. But yeah, it's interesting, their business they're taking on, but it's evolving right now, right? Like we were just talking about that when it comes to being in New York or Toronto, like REITs and retail are scary right now. Like I like RioCan a lot because they're trying to condense everything into city buildings, like one building, condos up top, offices in the middle, and a full mall down below. You never have to leave the building. Your entertainment, your mall, your shopping's all in one place. That seems to be the way everything is heading for like living in the future. But the problem right now is if you're in retail and you're investing in retail, go to your local mall. Our mall down here I go to, there's so many stores that have closed down. They're constantly switching in and out. You go to New York right now or Toronto, you don't want to be on the subway late at night. People don't want to go out like they used to. The rents are so high. The lease rates are insane. The margins are getting crunched. Like you don't want to be involved in retail whatsoever. It's another reason e-commerce has been able to grow so dramatically here. Like REITs are very complicated mechanisms these days. They're not as sufficient as they once were. And I think you have to be more selective. Like I wouldn't buy a REIT ETF. I do like, if I was thinking like super stable REITs, like as stable as they come, I would probably be looking at like American Towers or something that has some crazy specific moat behind it, like some of the Stag Industrials of the world, where it's more like a really hyper focused on a specific sector that you know is going to perform and be around for the foreseeable future. Because retail REITs, unfortunately, I think are starting to face a demise to some extent. Just there's no margins in those business, but MPW is close to a fraud. No one should touch it. Yeah, but it's the risk reward, right? If you look at MPW, it's arguably one of the most shorted stocks I've ever seen. And if you believe, if you generally believe that, the present value is, the future of cash flow, blah, 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 and you follow that like everything money philosophy, MPW is a screaming buy by like unbelievable metrics, because these are like your cigarette butts, as Warren Buffett would define it. Nobody likes it. It's a fraud. It's a scam. Everyone's taking up the headlines, but there's a huge fundamental business. This is the largest provider of hospital beds, like in the US, right? And I mean, you can't help but look at this. Going to the statistics here, and if you just take a look at the short ratios, I mean, not only is this mostly institutionally held, but it's 31% short. And I imagine most of the institutional holdership right now is shorting the company. So, I mean, this thing is in a huge potential for a short squeeze, because people, like, everyone just wants it to demise. It's like GameStop, but it's not like 99% shorted, right? But 30% is absolutely absurd, absolutely insane for a short. 3M, yeah, 3M MPW market uncertainty works for me. Good for you taking on the heavier risk for higher potential return. SCG, yeah. So a lot of you talking about a lot of these kind of companies. Sandy Co, CNR, can't go wrong. Yeah, those are good growth potential stocks. Vegas never sleeps. Yeah, I haven't been to Vegas in a bit. I got to go back. And the Bellagio is one of the top dogs in Vegas. Yeah, Vegas, it's an interesting place. I don't gamble as much, but I do like the entertainment side of Vegas. Super fun. Anyone looking at bonds or bond ETFs, I haven't looked as deeply, but they are part of the list. Some of you are mentioning some of these bonds. Very interesting. If you're playing a short play, maybe, but the accounting doesn't lie. Yeah, you got to dig some deeper into this stuff for sure. There's some big mix-ups with MPW. But moving on, I want to talk about Bill Ackman's portfolio here, because this guy is taking into different considerations with tech these days, but his portfolio is a little, it's fairly conservative, but like I said, he takes more risk on than I think a lot of the traditional investors like Ray Dalio, Warren Buffett do, and you'll see why, but take a listen.
Alphabet is one of your more recent investments, is that correct?
Yeah, we bought it late last year, early this year. Yeah, or early this year.
How much did that have to do with AI?
It had a lot to do with AI, because AI was the reason why the stock was cheap, right? ChatGPT was launched, incredible, game-changing kind of product. And Google really fumbled their offering. And so people said, oh my God, Google's way behind on AI. And the stock sold off to 15 times earnings for one of the greatest businesses in the world. And we did a fair bit of work, but Google's been almost a decade. They bought DeepMind, huge, spending billions and billions of dollars on AI. It's a company known for hiring great engineers. And you could certainly presume they were in a pretty good place on AI. But they're, again, very different from a startup. They took a much more cautious launch approach, and then kind of fumbled an early demonstration, made people think they were behind, and Microsoft and ChatGPT would sort of, if you will, OpenAI would eat their lunch, and it led to a very mispriced stock. And then we've bought more in the 120s. It's our second largest investment.
Alphabet.
So let's talk about how big of this investment is for him, because it only recently became like sizable, but I think his return might be a little bit exaggerated, because they actually started their first position around March. And I don't know if it was toward the end of March or the beginning of March, but if you take the low point of March, you should be seeing about a 40% gain, give or take, on that position. And I got to give the guy credit, because man, what an arbitrage play against the market conditions, because I do remember how much people thought Google and Meta and all these stocks were done for, especially Google when it came to the ChatGPT scenario, because it's what really started tanking it. And if I was a little bit more diligent at the time, but again, that's right around the time we were positioning ourselves for a real estate purchase. So I wasn't as, focused on taking on that kind of risk when I wasn't sure where my capital or how much was going to be where. But man, he played that like a fiddle, man, did a great job with it. But when you take a look at his holdings here, basically he only gives you kind of like these periods and then adjusted periods, but it looks like Chipotle and Google are only about 4% of his whole portfolio, which to me is still fairly risk adverse. I mean, no individual stock is like close to 5%. And it looks like they adjusted things like Chipotle or whatever. But the fact is it's not like Ray Dalio where there's any index funds in here. He does have, it looks like some bond interest expenses and interest rate swaptions. That's a funny term, swaptions. But yeah, all in all, his portfolio is very interesting. Hilton Worldwide, Lowe's, Universal Music, restaurant brands, very diversified because, I mean, again, you're talking about only like 14% of the portfolio here. So it's a very different take, and I love his management style. I wouldn't buy any of these stocks. His funds performed pretty well over the last 5 years. I think it's up 140%. But Google to me was a gem for him because he actually sold Netflix and took a loss on it to buy Google, which again really kind of eats into some of the returns. But either way, like he played it pretty well from that aspect of it. And Google to me is something that I want to get more in my portfolio. My fiance owns a very small position in Google. I wish she was more aggressive on it when she was buying it, because I think she was buying it for around whatever it was back for $90 or $100 a share. My fiance seems to have this horseshoe up her butt when it comes to buying stocks at the right opportunity. But Google right now, I still think is a favorable buying opportunity. I talked about it in my video. You can go check it out. I am going to probably start buying this one through October just to start refilling up some of the growth potential in my corporate account. Because Google, man, you look at the moat, go watch my video comparing it to Disney, and you just look at things like, I mean, self-driving, forget the whole AI side of it. The YouTube business just crushing like traditional streaming with, even the likes of Mr. Beast, who's going to be on the board of Forbes, for crying out loud. I mean, traditional media is dead and social media is definitely replacing it. And streaming is like, the no hopes to win game because the expenditures are way too high on that stuff. So I think it's just, Google is just one of those companies that I don't know how you live without. And speaking of like the robotic side of it, I talked about Tesla a bit as well in my video today, but I think there's a lot going on beyond Tesla when it comes to robotics. And I've been working with a couple companies, none that I would be intrigued enough to buy, but they're working on robotics for like warehousing. I think I showed you guys a video in a few streams ago where this guy was showing at like shipping centers for like big boats, shipping out like the big containers and stuff. And they had robotic dollies that were moving the containers around and saying that like this is all like AI and robotic driven. And that's the place where AI is currently like super fast evolving, but it's even bleeding into the makeup industry. Like, I mean, if you haven't seen these videos, this one's a bit older. I think it's from a year ago. But if you haven't seen it, this is just wild. Like this eyelash.
The machine is believed to be the first of its kind.
Right now, we offer what's called the uplift, which is kind of a universal natural style. Your natural lashes are a little bit longer in the middle than they are on the corners. And this sort of mimics that, but just enhances all that. And then we have the glam out, which is more similar to a cat eye, which is longer on the side.
Nathan Harding co-founded the business. Harding is a roboticist with a background in automation. Before Loom, he created
system. The only thing that can physically reach the client are these little featherweight tools. And those featherweight tools, not only do they have really soft tip tools, it tries to isolate a lash from the others. And then the other robot grabs an extension, dips it in adhesive, and then brings it over. It does a paint motion of the adhesive onto the natural lash, and then it places it and holds it on the natural lash. And then we blink the visible blue light and it cures that adhesive.
Harding said machines like this will one day be able to surpass human ability and accuracy. However, Loom says their goal isn't to take human jobs, but to provide clients with a different option that...
No, it's all human jobs that are about to get wrecked here, but I just didn't realize how fast this was taking over the beauty sector. I mean, just from every aspect, like forget even eyelashes, which is super technical. I mean, that's such a hard thing to perform, but nails, I mean, 3D printing, basically it was an easy solution to solve the nail problem, right? I mean, look at this stuff. I was watching a podcast that my fiance was watching, and she was showing me this of people testing out like all these robotic beauty, things, which again, why go to a spa, right? I mean, it's kind of mind boggling to me how much this stuff is coming into play. And I feel like we get too kind of blinded and just kind of narrow focus. What's the term for that? When you can't really look at the broad picture and realize like how impactful this really is from every single sector of the market. I always use like McDonald's as kind of that example, but McDonald's, I don't even think is a good example to how much, and anything you can pretty much think of is going to be replaced by robotics at some point in probably the next 10 to 20 years for major things like this, things that we use on a daily basis. I think are just gonna get wiped out. Is there a good AI ETF? Honestly, no. I don't think there's a really good one because the market evolves too quickly. I think when it comes to AI specifically, you just want to play with mega caps, or again, just buy the S&P 500 because it auto weights all those companies to the top anyways, especially because Microsoft, Google, Tesla, all these companies are leaders, right? Especially Apple, Meta. I mean, you don't really have to specifically get an AI ETF. It would be I think a crucial mistake because AI, I think, is more or less in a bubble right now to some extent. And a lot of these things aren't cash flow generative, but a lot of the stocks have rallied way too much. Tunnel vision is what I think people have right now. Same thing with crypto, right? I mean, NFTs and crypto, I think, are still going to be a huge proponent of the future, but people have given up on it. And, AI is the trend right now, but it won't be. These trends, as I mentioned, tend to last 3 to 6 months. If you're smart and you want to take that investment thesis on, typically you look for trends. And with 2 or 3 months, if you can find a long-term trend taking place like AI, you buy it, you sell it in 2 months, you pick some of the stocks like NVIDIA or whatever, and you just try and play those trends because they tend to last longer than people think. And I think we're on the cusp of the end of it. Because I just don't see NVIDIA rallying. If it does, I'd be blown away, but I just can't see NVIDIA going like any moonshoot higher than it has already. It might be more conservative at this point. We'll see. I could be wrong. Chad, the ticker, we're taking a look at a few things. The like button as always, folks. If you're playing shorts, not too many more comments here, folks, but to round the conversation off into my portfolio side of it, what I'm looking to do, as mentioned, I've gone through this very 2-year phase that started in 2022 where I lost faith in my ability to pick individual stocks. That's essentially what happened. I mean, over the last decade, as mentioned, it was incredible to think companies like Amazon and Google and Apple were posting double-digit growth consecutively year over year. You couldn't do absolutely no wrong. And I think in spite of their own capabilities, government intervention to what was a once in a lifetime kind of event being the pandemic led to an absurd amount of printing and led into a bubble. And it wasn't caused by the growth of these companies. It wasn't caused by overvaluations in stocks. Yes, they were expensive, but they were justifyingly expensive, growing at double-digit paces. Again, that could be artificially propped up by lower interest rate environments. You could have raised the interest rate to a more nominal 2 to 3% anytime during the last decade. It could have slowed the performance down a bit, but the growth would have still been there. But thanks to the government intervention of a once in a lifetime kind of catastrophic event, it led to the current, scenario that is conspired in front of us here. I mean, this is all caused by the government. Overprinting, inflation, none of this stuff is caused by these companies. These overvaluations weren't caused, but the overvaluation takes effect when these double-digit growth rates drop. So when you have companies growing at 20 or 30%, like we've seen for the last decade, and then all of a sudden interest rates go from damn near 0 to 6%, spending tightens up, and people have to focus on where their money's going. All of a sudden they're not buying an iPhone right away. They're not spending as much ad dollars as they were. And now all of a sudden it doesn't make sense for Google or these companies to be trading at these wicked multiples, which a lot of them are back to pretty much being there, right? So that's it's like a self-artificial little bubble and overvaluation in the market, but it's just a temporary problem, in my opinion, that we have to ride through this for the next year or two, but it's opening up an incredible amount of buying opportunities. And I think there is just so much potential that we don't have a lost decade ahead of us. I don't think we're going to go through what we went through from the dot-com bubble to, say, 2008, 2010. I have a hard time believing that because everything just feels so different about margin expansion, robotics, and all this stuff that I would rather overpay for some of these companies today. And again, I think overpaying is not the right statement because that presumes you're only going to buy it once. And I keep saying this when it comes to like everything money. It's dumb that if you bought Tesla at the top and that's the only price I'm going to pay for. No, it's like, it didn't matter if you bought the top so long as you bought all the way down, because then you get what the market considers to be the average price for those kind of companies, right? So I don't think Google's overly expensive here. It was a better buy $30 ago, but I still think it's fairly favorable here. And I'm looking at like 3 or 4, maybe 5 stocks that I wouldn't mind buying over the next year. And Google's going to hands down be one of them. We'll scale that up, get it more comparable to Meta's size and mine and my fiance's portfolio just to start matching some of the holdings here. But I just love Google a lot. I like Tesla. I have a hard time with Tesla because I can see how the valuation is nuts, not compared to the valuation of growth. If you look at the growth trajectory and you only care about revenue growth, it's a little more favorable if you value it that way. If you value by EPS, it's by leaps and bounds too expensive. So I'll wait for earnings. I really want to see what Tesla earnings look like, but I can't. Tesla's the one that I've always been a little frustrated with because I can't understand it. And it scares me to buy stocks that I just don't have that same concrete feeling that I have with, say, Google that I do have with Tesla. Because you got to remember, Tesla, I feel like Google's business is so concrete today. It's like a golden, it's been so well formatted that no matter what happens to their future investments, their core business is going to continue to grow. And you could say that about Tesla's auto business, but Tesla's auto business, if it grows even at a ridiculous pace, you're still paying a hefty premium just for an auto business. So some of those other techs have no other scenario, but they have to work for investors. Like one of those things have to explode, and I'm highly confident they will. You're just taking on a lot more excessive risk if those things work out long term. So I'm looking at just conspiring a little bit more speculative risk in my portfolio. Obviously, I own small caps, really small percentage of my portfolio. Those are things that I just play with just through my own work, things that I run into with personal people that I work with, like say Parcel Pals or like Aduro Clean Technologies, which Aduro is what hit like $1.30 or something over the last week, pulled back a bit, but my God, that thing went flying for some reason. But yeah, I'm doing this within my corporate account because it makes the most sense not to be owning dividend-based income, as my accountant has reminded me a couple times now. But what I'm going to look to do is basically take some money. I want to get 10, 20,000 by the end of the year that I'm going to put in my tax-free savings account. And within that account, I want to go not ultra conservative, but I'm looking at weighting maybe 3 or 4 different kind of ETF styled investments. And I may be even thinking about buying things like Berkshire Hathaway in there, but I really just want ETFs passively managed, things that in case I, for whatever reason, pass on, they can just keep doing what they're doing in perpetuity. People don't really have to sell them. They can transfer the shares. It'd be great. I really want my core retirement funds to be that inspired idea that if I pass away tomorrow, this is something that I would be comfortable handing off to somebody else, knowing they'd never have to sell one of the stocks. I think that's like the end dream of every like retirement portfolio, is you just want something positioned so well that it's generational, right? So you're not as worried. Whereas you're buying these individual stocks, people do have to remember they have to be managed, and you have to manage them correctly and pay attention to earnings. So I don't want to over concentrate, but I do like those kind of tech companies. I'm also looking at things like, what is it? The other railway here. So you have like Canadian National Railway, then you have the Kansas City Railway that just kind of had the acquisition going on. I do like the idea of the railways. I noticed Bill Ackman owns that as well. The railways, I think, are another incredible moated business. They have huge growth potential ahead of them still. A lot of boring stuff on that side of it, but it's hard to get overly excited about tech because there's just so many things that have to go right. Whereas with some of these like railway and traditional companies like Proctor Gamble, which by the way, I mean, Procter Gamble's been dipping quite a bit here. These are the kind of stocks that I always recommend putting on a list and just waiting for them to drop, and then just buy the dips, because, Procter & Gamble here, let's take a look. How far is it off its recent highs? I mean, it's down about 7%. If this thing ever got back up to a 3% yield, I think favorably this one, I think there's Warren Buffett still in Procter & Gamble. I know Ray Dalio does. Like, it's just such a foundational company. The problem with Procter & Gamble, I think the growth behind it's kind of alleviated. So it's one that I'd rather play a bit more strategically than try and cost average into it, because I'd rather just see when it drops like it has now and start buying it here. I think even here is probably a good place to start getting into it. But you want to buy the dips because it's cyclically, it dips every year. Like you'll see it dip 3 or 4 times, and it's just easier to buy it when it drops than it is to just buy these tops or buy like the averages, because that's the only way to like squeeze out a little bit of extra return and make sure you're locking in a higher yield on a very valued company today. But that's playing individual stocks. At the end of the day, like I said, it's always easier just to buy things like SCHD. Yeah, Kimberly Clark's really good. My focus is monthly cash flow and preserving that. Yeah, see, that's the thing that I don't want to say died in me, but like, I've been like kind of not divisive, but I guess just split between dividends and growth, because most of the real returns in my portfolio have come from growth and not dividends to some varying extent. I did own good dividend stocks that I sold at great prices that grew pretty dramatically. Apple, Northland Power, a whole variety of things, Microsoft, but when it really comes down to it, I as young as I am, and I think about this, and it's what's kind of putting me in this new place of thought for a little more speculation, is now that my life is stable. And if you have a stable life and you don't need to rely on dividends, I know yield on cost is like an ego thing that drives a lot of people. My yield on cost on Apple was like 5%. It was kind of nuts, but like, that doesn't matter, because at the end of the day, like the total value of the position, like that's the total investment you have. And at the end of the day, that total value is still giving you the same dividend that if you were to sell it and buy it back at the capital gains you have, you're still getting the same dividend yield of whatever it is today, right? The yield on cost is just something people take into the ego play of things. So really, to me, it's still total return at a younger investor's days. And again, if I want to fast track my retirement, again, you might be at a different age group, right? Like talking about retirement funds. But for me, I I can't give up on the idea of like, I want mostly S&P, mostly index SCHDs, et cetera, but just to inch out that performance, knowing that if I put 5 or 10% of my portfolio between things like Google, Tesla, we have some Meta already and Apple, and just core focusing the stocks that I still love a lot, believing in their future. And even one of those works out, because a lot of people think, oh, you go back to the early 2000s and the S&P 500, half those stocks, they're not even around anymore. But the fact is if you picked like 5 of the really awesome top 10 companies on the S&P in 2000, things like Walmart, I don't even think Apple was at the S&P top 10. It might have been, but I was looking at things like General Electric. But if you picked like even something like Walmart, and you pick 3 other bad stocks, the performance of something like Walmart, when these stocks, especially like Apple, go up 500 to 1,000%, you only really need one of those to make up for like all the losses in the portfolio. But again, do I have the ADHD mental stability to go through that? I mean, it's funny how hard it is to actually do that successfully. And I don't know if I've got the guts, but maybe we'll find out this time around. Not perfect. It's I'm just skimming through a few of your comments here. True value investing days are over. Growth is, I feel. Yeah. Value investing days over growth, I feel. Again, define value investing, because at the end of the day, all investing is value investing. You're always looking for value into future potential. But again, define it, because you could tell me that value investing is buying discounted companies that have excessive, cash flows against their price to earnings multiple. But then I can show you a ton of companies. If you own British American Tobacco at the wrong time, again, that's the odd thing about cash flow, is we kind of get stuck at what the value of it is today, not presuming the risk into the future. Because again, you look at British American Tobacco, again, today I think it's a great value. But the fact is if you thought it was a great value during 2016 and that's where you were buying it, and you only put so much in during your retirement and you couldn't add any more money to it, that's the risk of these companies, because it's down 53%. There's no dividend return over the last 4 or 5 years that would have really made up for that 53% if you bought it anytime basically between 2014 and 2017. And it was a good valued company even back here, right? So that's the thing with value investing, is it's not just numbers. Again, you could have said Tesla was this crazy overvalued company in 2019, and you could have went with that whole idea that it's just some car company that's too expensive, and you would have just missed out on one of the greatest gains pretty much in stock market history, right? So it's value investing is just everything. It's just the same thing as buying a growth stock or a dividend stock, because dividends aren't the end all be all return. It's just total return. And that always isn't cash flow, which is unfortunate. I wish the market was more like that. I think the market used to be more like that once upon a time, but not anymore. I think value investing is just kind of a silly term people like to use these days to run their formulas on a calculator and then try and present it to a group of people and convince them why their calculator is worth buying. Absolutely agreed. High interest rates just make it harder to grow. Yeah, but that's the opportunity. I think there's so much opportunity right now, and I'm going to finish up with this, but I mentioned this and I'll beat it like a broken record. Again, if you want to take on the risk today and buy individual stocks, I would more or less focus on 2 aspects of the market, and one of them being dividend stocks right now, which again, I have my exposure to dividend stocks. I'll always be buying things like VDY, where I think there's huge potential for the diversity in those kind of companies. But when you look at a company like TELUS, for example, and these companies have real potential to cut their dividends, but if you look at these companies and you are a value-focused investor per se, you look at the cash flow these things generate, and they're getting eaten alive. Their earnings per share are getting eaten alive because of this higher interest rate environment, which presents the opportunity of speculating that interest rates are going to get cut in the future. And we know they're going to get cut. There's an inevitable circumstance of these rates getting cut. So what you want to do, if you have the time and the diligence, figure out the loans on these companies. Look at TELUS, figure out if they're floating line of credits, figure out how they have all that debt and that infrastructure, and figure out when the max rate is going to affect their earnings, and wait for that earnings to hit with the max rate taking effect, because that's where they'll be paying the most amount of interest, eating up their return. And that'll be the max pain for the company, and start buying it there, because inevitably if they start cutting rates by half a point, a percentage point, you're going to be talking about tens, if not hundreds of millions of dollars of added cash flow to their earnings per share. Look at the banks right now, for example, right? Like, people think banks are trash. Come back to me in 3 to 5 years and tell me that right now wasn't a good buying opportunity for them. I could be wrong. But I just can't help but check out their record revenues. Higher interest rates make them more money. Yeah, they're going to deal with some shaky loans for the time being, but that comes to an inevitable end. It's just my opinion. Don't take it as financial advice. I'm an idiot, a clown on YouTube who plays VR and makes fun of little kids and shoots them. So on that note, folks, I appreciate y'all coming out. Stay cool. Enjoy your weekend. And I look forward to catching you in the next one. Peace.